Good afternoon, ladies and gentlemen. It is Monday, the start of the week, September 15th. We got a big week ahead of us. I'm going to share some interesting insights that I found on an 18-year channel with the dollar that it's currently in. I'm going to be talking specifically about what the market's pricing in as far as risk going into this big week, which happens to be Fed week. We're going to talk about some of the breadth indicators taking place. I'm going to give you an update on the Sailor to Shift tool. And most importantly, we're going to look into the current market conditions. On top of all of that, people, we're going to hop into what it is that I've been doing leading up to this specific day and this week in my personal trading portfolio. All that on today's Stock Market Brief Show. If you haven't done so already, make sure to hit that thumbs up. I'll go ahead and draw a little thumb right here. It's greatly appreciated. All right, let's get into it. All right, ladies and gentlemen, welcome back to the show. All right, so I'm going to share my last month performance. You can always check my performance on the United States Investing Championship website. I do that just because most, YouTubers don't provide valid proof or verified proof that, they walk the walk, they talk the talk, or whatever the saying goes. Well, right now, as of now, right, you can see it's at 38.74%. That's my cumulative pre-tax return. This is, my account, 38%. The S&P 500 is about 13%. This is the last month P&L, right? It's doing good. And then as you can see, really recently up here, the projection of this has slowed down a little bit. And that's because, well, I've been taking down my portfolio. Now, just so everyone knows too, this is my swing trading account, right? I don't do day trading out of this. This is majority swing trading. I do active day trading. I made a video for those that are interested in it. I did a video that looks like this, where I shared a strategy that worked really good in different market conditions. So if you haven't seen that, go ahead and watch it. In the video, I shared my performance. This is from March, April, May, June, and July. And basically what I did there was I utilized a prop firm, Tradeify. If you want to look at put the link there just below this video. But I took $2,500. I bought 5 of their accounts and I ran it up to a total payout of $80,000, but you only get 90% of that. So $72,000, which is a 2,700% increase. That is the day trading aspect of it. It's great to do. It's hard to do because you have to follow other people's rules. But I'm going to specifically talk about what I've been doing for my bigger account, my swing trading account, and which is doing good as it stands right now. Now, for those that don't know or follow me on Twitter, I posted that I am 35% invested, which means I have 35% of my portfolio in risk assets, whether that's long or short. I do have a little bit of a short position. I guess I'll share that with you. Today, I do have the chart. I initiated that. Majority of it was today I initiated it. And then 65% cash. So what this is basically doing and what I'm basically doing as the market's kind of progressing itself higher, I have been selling into it. I haven't really been adding too much exposure, and I'm just getting ready for getting through this Fed event and then looking for good setups still. And if conditions change, right, my attitude will obviously change as well. Okay, now I found this chart to be pretty interesting. I was looking at the dollar from a long-term perspective, and I noticed that really the dollar, which is this chart above, has been in a channel, a bullish channel, right, from the 2008 bottom, right? So 2008 was down here. We kind of undercut it down here, and you've tagged it multiple times. And then we've come up to the high multiple times here and been rejected. Most recent was in the middle of 2022, and it's been rejected. And you've seen pretty big thrusts from these specific levels. And I thought it'd be interesting to look back and look at what has happened to the S&P 500 during these specific times. And in short, it's basically been a great barometer showing that when you get to the lower portion of this channel, it's been a good barometer to say, hey, maybe reduce your risk because we could potentially see volatility. But then also on the flip side of that, it's been a really good barometer for saying, hey, let's go risk on while we start to get to the upper portion of this channel. As you can see here, once we tagged right here at the upper portion of this channel now in hindsight, right? We didn't know that it was going to be there obviously in 2009, but that happened to be that 2009 bottom pretty much with pristine accuracy. And then over here, you can see that, hey, it told us to slow down a little bit. Overall, this has been kind of going sideways, but you can see a few times where it pressed down, and then right over here, it pressed down, and these were kind of at this low, it moved higher, and then right over here, which is about right in this area, it went into a massive run to the upside, then went a few years with volatility and so forth. And then the most recent one was in 2022. We came all the way back up to the top portion of this channel, which actually marked the bottom of the bear market in 2022. And then leading into that, right, we hit the bottom channel. The market still pressed higher, but it did give us some insight. Now, why am I bringing this up now? Because just recently at the beginning of this year, we did hit the bottom of this channel. And as we hit the bottom of the channel, well, we went through a 20% correction in the S&P 500, or 20 and some change. I forget exactly what it was, but it was obviously a lot of volatility with the whole tariffs and everything that was going on at that particular point in time. And we're still down here at this lower portion of the channel. And as the market's been falling from this high, what has it been doing? The market's been going straight up. And now we're coming to the area where saying, hey, if this were to doodle around and come back up, is that going to put pressure on the S&P 500? Well, history says that that is the case. However, what happens if we actually eventually break down from this channel and then start to head lower? Well, I think that that's where we got to really just consider continuing to look at the correlations that the dollar has with other various assets, and just be aware we're at an area, right, that has many touch points, right? 3 main touch points that we've seen very, very explosive moves from. Okay, so if this breaks down, perhaps that continues to keep that negative correlation. We'll see, you know, what the rate of change look like if that was the case. We can't predict that right now. But if it were to move higher, as we've been stating, that typically happens in the back half of September, well, that means that chances are, if you look at the near-term correlations, the dollar has been falling, the S&P 500 has been going higher, and that goes with the 10-year yield as well. It's been falling, and the market's been heading higher. Now, we do have, obviously, jobs report. Sorry, not jobs report. We have the Fed press conference, and the interest rate decision is what I meant to say, coming in on Wednesday. And I did find some very interesting stuff about Thursday and Friday, which is where we're kind of tapering off from any sort of real big macro event. The big event is actually here on Wednesday, and you can see the market's currently pricing in, as it stands, a 25 basis point cut, pretty much 100% certainty, right? If not, it is 100% certainty actually that the market's pricing that in. And then if you look at the last, months of the year, we're looking at a 75% chance of another 25, and then a 68+% chance of another 25 basis point cut. Now, what I do find interesting here about this is what the futures are pricing in. However, if you do go into something like Polymarket, which I don't have the chart in front of me, their probabilities are not as aggressive as this. They're actually lower probabilities that they're going to be doing these rate cuts, at least this aggressive of a projection into the end of the year. So this Fed conference is really going to help us determine what that might look like. And if they come out and basically the market says, oh, we're not going to probably do these 3, we're going to start pricing them out, what does that do to the overall price action that we've been seeing? Because that sees now, right, the market is a discounting mechanism, and it has been running. It's been pressing higher and higher, discounting, right, what could potentially come. So is this going to be a sell the news event? I don't know, but I do want to point out something very interesting. So this is the SPY options chain, and if you pulled up the SPY options chain, you can look at the expected moves, and I'll talk about the weekly expected move, daily expected move momentarily. But what I want to call out here is the day heading into, right, the Fed interest rate decision, we have about a 15.63% vol, and that equals and equates to plus or minus, right, dollars of expectations of movement for that day. Now, Thursday and Friday, we don't really have any big data that outweighs the Fed, right? That is the big event of this week. But what I find interesting here is both Thursday and Friday are pricing in higher volatility with a larger expectation of risk. So I don't quite know how to interpret this right at this moment, but what I have been seeing has been people been posting about the VIX that rose today. So perhaps it's seen more volatility here, and that doesn't necessarily mean, bearish or bullish, right? It's plus or minus, but it does see risk expanding. Hopefully that makes a little bit more, clarifies what it is that I'm trying to say. Risk into the end of the week is actually expanding past what the main event is saying. And that's as of right now when I pull this data up. Now, if I take a look at this SPX on the daily time frame, you can see that we started the month off pretty poorly, but from that point, we just kind of grinded higher, higher, higher. This is a very similar type actually move that we saw in August. It is very interesting, right? That we started August on a move down, and then we just grinded higher and higher and higher, and then we came back to the bottom of this channel, and then we started down here at the bottom of the channel, and we grinded higher and higher up to around that 6,600, which we're currently above. above. So it's going to be important to see what the market here, where they're reaching, right? We have an OPEX this week. That could be why we're seeing more volatility towards the end of the week too. That could be a possibility. And it's going to be one of the largest option expirations. So we'll see here where the market's going to be reaching towards, if it's higher and to higher strikes, and where we can be very careful of if it starts falling below. Now, today's move was a Mag 7 day, right? This was generated from the larger tech stocks. You can see that because you can see if we're looking at the heat map of the S&P 500, we see a lot of red on our screen, but you got moves like Tesla going up about 4% and Google, you know, these are both off their highs, but still finished up 4.3% and 3.56% on the day, whereas NVIDIA was flat. AVGO, which could be considered one of the Magnificent Seven now because it does have a weight, 1.17, Microsoft up 1%, you know, Amazon up 1.5, Apple 1%. It doesn't really hold any like weight to the Google and Tesla move that we saw today. Now, a few videos back, we talked about how this bullish divergence was kind of mapping out, how I'd like to see it lower, but nonetheless, it was a bullish divergence that was forming, and you could see it resolved itself higher. So it's important to watch these bullish divergences form. It's important to watch the bearish divergences form. Now, as I'm looking at this, the market's pressing higher and higher. We're still a pretty low reading, which just tells me the internals of this technology sector right now, it's kind of weak, but yet you have a few names really driving it forward. And we're not overbought or oversold right now, so we can't really do much with this info. If I do look at the Nasdaq Composite, which is the it's a more broader market, but there is a lot of weight within the semiconductor space and tech space. You can see that its RSI is moving into more of an oversold state. It's not quite there yet, but if this were to press up a little bit higher and this RSI were to get oversold, that would be a bearish divergence forming in the Nasdaq Composite bullish percent index. While this is happening, if you look at the Nasdaq 100, the market's continuing to press higher to new all-time highs, and then the percent of stocks above the 50-day moving average have been continuing to fall, indicating that yes, this move is going higher, but yet we have fewer and fewer stocks that are actually above a 50-day moving average. In fact, only 44% of the stocks are above it. Not even half the stocks in the Nasdaq 100 are above a 50-day moving average. There are more than half stocks above the 200-day. But as you can see, as the market's pressing higher and higher, this has actually been going lower and lower. So this is just a little bit of a breadth divergence. Divergences, they can build out over time for a while. We've seen this happen, and it will eventually resolve itself, whether that's to the downside or we're going to see more breadth come into the market. That would be the other way of looking at this as well. If you look at the S&P 500, the percent of stocks above the 50-day has been dropping, 200-day has been dropping, the market has been pressing higher, so there's a little bit of a breadth divergence there as well. If we look at the Sailor to Shift tool, the Bitcoin has been going up higher, and we were kind of indicating that it could come back into and around that 115, so we got a little extended, but I still don't have a buy signal or a buy trigger because gold has been outperforming Bitcoin, right? And when that's the case, well, you get a negative rate of change in this specific indicator. You can see gold here breaking out to a closing new high and a new all-time high and a new high on that RSI right there as well. As of recent, we talked about it, this one where we can typically consolidate. We consolidated, we broke up higher, and now the RSI is a little bit more frothy, back to a level where we saw over here. It led to some digestion, and then back over here too as well, where we've led into periods of consolidation there as well. Now, I mentioned that I am short now. I'm starting to build into a short position, and that happens to be in something that I believe is a little frothy right now. So I'm fading the bullish nature of the move, and that is in the miners, and it's GDX. So I'm looking at GDX as the proxy. Now, I'm not using GDX to short. I'm actually using DUST because in my main swing trading portfolio, I cannot actually do any short selling. I can just do like an ETF, an inverse ETF. So this has been flying higher. I'm not looking to see this thing crash down by any means, but perhaps get a few points to the downside. And it might come, after the meeting, maybe next week. I don't really know. But one thing I do know is that the distance that we are from the 200 EMA is something that we've only seen a few times in history. That happened to be at 2020, which was right here at around a peak. And then also here in 2016, where we ripped really fast, we could pull back and consolidated, ripped even higher, and then that actually ended up finding itself a top too. So as I'm building into position, just know that shorts are shorter term holds for me, right? And they're not as big as positions as I typically go via the long aspect, but I do find it to be pretty extended, pretty frothy. It has a high correlation to silver, and silver recently broke out of somewhat of a bull flag here. So do I think that it can go higher? I think that that's very possible given the context of everything, but I also do think that we're due for some quicker, aggressive consolidations and pullbacks in what I would believe to be the near future, 1 to 2 weeks, right around there. So I can see if I can get my position on fully and then see if it happens and take some profits. If not, then obviously I just get out of it. If we take a look at Bitcoin by itself, you can see Bitcoin did come back up to that 115 marker. I mean, it doesn't look horrible here. I will say Bitcoin relative to the S&P 500 hasn't gone anywhere or flipped back above its 50-period moving average there, or EMA, but it is not looking too bad. It's just back in this kind of 115 to 117 kind of happy point, right? We broke through it, we came back in, we broke through it, we came back in, we came back in right over here. We're kind of just right there. So as we're still on a sell signal, sell trigger, I'm not looking to really gain much exposure in Bitcoin until that changes. Yes, in the very near term, I'm seeing this uptick. That's a positive sign. I like to see that. But as it stands right now, you know, if I'm doing it in an equity or Bitcoin, it's going to be really well timed. It's not for much longer of a swing trade. It'd be shorter term kind of executions. All right, let's look at the market conditions of the market. A lot of people were talking about the VIX being up higher today, up 6.3%, about 1 point, right? 0.93. And yeah, the VIX is higher. And then when I look at what I showed earlier, as far as the options market, what they're pricing in for the S&P 500, perhaps that has something to do with it. Maybe they underestimated how much volatility there might be. Now they're starting to price that back in. If you look at VIX futures, I mean, relatively flat, you know, overall right now. So not much movement there. And if you look at back month versus front month volatility, it's still elevated, but it did come under that 1.2, given the context of that VIX, a little spike that we saw here. And these are still the areas where we can see consolidations and pullbacks in the market. So I'm just keeping an eye on this as the market's kind of just pressed higher. We're up about what, 2.5%, right? 2.5% in the price of S&P 500 for September. So if the back half of the month holds true to its seasonality, where it's typically weak, wiping out 2.5% is really not that big of a deal. It would be a flat month if that was the case. If it keeps going higher, awesome. But that is currently what I'm seeing. Skew, if you look at skew, it did elevate today. So perhaps traders are reaching for protection as it stands right now going into this Fed event. If I look at the total gamma, you can see that traders are reaching out to 6,650 and even 6,700. So this to me, you know, is pretty bullish, right? Traders keep on continuing to press higher and higher. Now, a lot of gamma exposure is going to be rolling off, right? Because we have a big option expiration. So we'll see what that looks like come next week. But as it stands right now, traders continue to reach further. When I look at this, 6,600 as of right now is the call wall. So anything below 6,600, I'd be a little bit more cautious about. And then anything that we can hold above, I'd be looking for 50 to 100 points higher as it stands. Now, we have been going on this kind of just grind higher. If we look at where the gamma flip line is at, it's at about 64.80, which is underneath the S&P 500 lower weekly implied move. So we're in a kind of a environment where vol gets suppressed, right? If the market moves down, the dealers will look to buy that dip. Then they'll sell the rip, buy the dip, sell the rip. Okay, it's when we get under the gamma flip line where things can really kind of explode in terms of volatility and systematics, given the context of where they currently stand, which I'll show momentarily. But for the S&P 500, if we were to continue to press higher, the upper weekly implied move is at 6,678. The upper monthly is at 6,692. The upper quarterly is at 6,685. And as I've already previously stated, there are traders reaching out to and around 6,700. So if we were to get out here into September, those would be that big area of confluence to just be more cautious around. So as the market presses higher, what do you notice, right? If this was the reward, what do we see for the risk? Well, the risk underneath that 6,600 could potentially be growing in size, right? So risk and reward, when you think of it in terms of this, the reward to the upside as we move higher minimizes, and then the risk grows for the downside. So you got to be very tactical in your approach, which I've been doing personally. All right, I've been selling into the move higher, and then I will look to add exposure as long as we can, you know, hold above the gamma flip line, and as long as this trade setup makes sense to me. And that would take me from where I am at currently, which is 35% invested, maybe to 45 to 55 to 65% invested. after that volatility rears its face. And if it rears its face. Now, what do I mean by it can get pretty nasty fast if we get under the gamma flip line? Once again, I'm going to just bring up the chart of CTAs. You know, we haven't seen this for quite some time at these levels. CTAs have been a mass proponent of buying, and things could get kind of exhausted at these levels as the market continues to press higher. There's just less buying power in here. And what I pointed out in the past too was the times that we've gotten into these levels prior and how it's led to corrections in the market, and CTAs, right? They help really kind of dramatically create more of that sell side volatility that we saw in those markets. But it's just not CTA position. You could also look at vol control funds also at these elevated levels here too that we haven't seen for quite some time. And shortly after these times, when they become sellers, if we get under the gamma flip line, when we get under it, right, it's going to happen at some point again in the future. They can become sellers, and that could really add to the moves, like volatile moves that you see in these markets. The last thing I want to close off here is with the expected move on the SPY. We'll look at the daily implied and the weekly implied right now, right? We're above a rising 5-day moving average. We're starting the week off strong with a little gap up. This is, you know, a gap in camp. This is what I would call a gap in camp, where you gap up and then it camps sideways for the majority of the day. Tomorrow's daily implied move can bring us down to around 658 to 656. That'll bring us basically fill the gap on, you know, this week's gap. And if we start moving up higher, we have 664 to 665, and that would also bring us to SPY's upper quarterly expected move. Now above that, we have our monthly and we have our weekly implied move. Our weekly implied move is at about 667, and then we have our lower one at 647. So put these levels on your screen. Remember, it tags these very frequently, right? So to tag one of these, right, if the market's still pricing in over $9 a risk for SPY, right? We just pointed that out. So to tag one of these is very likely, right? It happened this year. It has happened over 70% of the time that we've tagged the risk, that implied move. I went over those statistics in a previous video. I'll perhaps bring them up on another in the very near future, but that's all I got for you for today's video. I'll see you on the next.